focused on the narrative around reflation, the narrative around distribution of vaccine use, and the data's just supporting it. It's hard not to be participating. And even though we're marginally underweight, looking
Yogi,
to reduce
let's
our
just
exposure.
pause. Yogi, let me just interrupt you and just pause for a moment, because you've jam-packed. It's a Big Mac, so to speak. So let's unpack the Big Mac. I do like the cheese in a Big Mac. So let's deal with the equity markets first of all. You say that equity markets to you look overvalued and overbought. Let's dissect this a little bit. Where is perhaps the most overbought and overvalued markets in your opinion?
Definitely in the US equity markets, with forward PEs at 23. Definitely within the technology sector, when you get PEs in excess of 30 to 35 on a forward-looking basis. We've obviously seen a rotation into value names and into cyclicals. We like financials as well, but valuations look more reasonable in that regard. But they're the sectors where we're being very careful with everything that's actually going on.
So let's just dig a little bit deeper into the financials, because that's going to tie back to steeper curves and perhaps an earlier taper and tightening, perhaps, if I'm correct in drawing the dots together for you. So my last guest said we could see a taper around Jackson Hole. That could be the narrative then. What is it that drives the taper? Is it this social inflation that we are seeing, as he said, in the ISM? What drives the taper? Is it the unemployment number or the social inflation? Should they taper on social inflation?
Look, inflation in the US now is at 2.6%. In Europe, it's at 1.6%. It's unlikely that we're going to see masses of inflation in the short term. So I think they're really going to look more closely at the unemployment data that's actually coming out. And of course, we've got a big jobs report out on Friday this week. Everyone will be paying very close attention to the data.
Let's just reflect back then on the Bloomberg story that's come out this morning, and this looks at the data in terms of those portions of society that are being left behind. Bloomberg's done the analytics. We use the word string. We need to see a string of job creation of more than 1 million. I said this yesterday before the real taper debate rises. But this differentiation in terms of white to black unemployment, white to Hispanic unemployment, and Asian unemployment. These gaps are widening, and this is something which is being talked about. It is being reflected upon much more so than at any time in the various hiking and tapering cycles that I've lived through. Is it something that will become much more of a prescient factor for 2021?
I think investors are paying very close attention to the mix of unemployment and how that's reflected in the data. However, I think it's the headline number that investors are very focused on. They want to see unemployment come down. That will be reflected in earnings numbers, and then we will start to see, obviously, the narrative for higher rates. And remember, the narrative for higher rates, Manus, is obviously unemployment improving, but also fiscal spending has to be paid for. Growth isn't a freebie. It actually requires a lot of bond issuance. It requires a reduction in tapering. All these things will contribute in a meaningful way to the growth narrative that we're about to see. But ultimately, the consumer has to feel safe. And if the consumer isn't feeling safe because they're worried about their job, then they're unlikely to spend. And then the reflation scenario that the market is very focused on slows down. And that's what we really want to try and avoid seeing.
Yogi, stay with me. Yogi Dewan at Hassiam Asset Management. His calls on the market. A little bit of caution there. Let's get to Annabelle Drulers. She has the first word.
Thanks, Manus. Well, in India, Prime Minister Narendra Modi is resisting pressure to lock down the country, despite the surge in COVID cases and deaths. 2 weeks ago, he said states should only consider lockdowns as a last option. But now everyone from political allies to business leaders sees it as the only way to stem the world's worst coronavirus outbreak. There's more easing of pandemic restrictions across New York, New Jersey and Connecticut. All-day subway services will resume on May 17th, with capacity restrictions on restaurants, theatres and stores ending on May 19th. New York Governor Andrew Cuomo described it as a major reopening of economic and social activity. Bill and Melinda Gates are getting divorced after 27 years of marriage. The two say they'll continue to work together on the Gates Foundation they created, which has so far given away more than $50 billion. According to Bloomberg's Billionaires Index, the pair are worth an estimated $146 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Manus?
Annabelle, thank you very much. Annabelle Ruhr is there with the latest First Word news. Coming up on the show, Germany will loosen its COVID restrictions for vaccinated people. This as the EU considers opening its borders after more than a year of isolation. We're live in Brussels. That's next. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andris Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We've all learned from the pandemic in terms of that we can actually work from home and work from the office, and it will always be a combination going forward.
We're very keen going forward, actually, to make it easier for employees to have a balanced in the office, at-home work environment.
It'll really be up to the employee, but in a structured way with the manager.
We will see a hybrid way of working in the future, where the office is the place to meet and interact and be creative, and then you can work at home for some of the quiet time and the quiet work.
I don't think you'll see a strict mandate from Barclays saying you have to be in from this day to that day. And I think we will rely on flexibility.
We're committed to a hybrid-based working environment for the long term. We think this is the future.
Industry leaders there on the changes to come in the workplace, flexibility and hybrid working, the latest buzzwords, or as Ralph Hammers said to me when I was in Zurich last week, a democratization of choice. Let's see how that plays out and what drops into your inbox in terms of when you've got to go to school. Now, speaking of changes brought in by the pandemic, Germany is looking to loosen some of the COVID restrictions for vaccinated people. Proposed new laws would mean that those who have been inoculated will no longer be subject to curfews, restrictions on socialising. This comes as the EU looks to open its borders after more than a year of relative isolation. Let's get to Brussels. Maria Tadeo has the very latest. Maria, this is everything that the politicians promised their citizens would not happen. It was your free choice in terms of whether you took a vaccine. That is very much clearly not the position if you wish to have liberty.
Yes, Manus. And look, I think it's very clear now at this point. It's really that incentive to get the vaccine that you would get all of these perks. But that is a conversation as to whether or not we're creating a two-tier society. But I guess the decision now from governments is that one way or another, they have to salvage the economy. They have to reopen. And that means vaccination one way or another. You have to incentivize the public to get the shot. Now, the numbers in Europe, as we've talked about, they have really improved in April. We've seen that momentum really picking up in the rollout. So that seems to be working. Now, with regards to Europe reopening for the summer, that's also something the European politicians had promised, that this summer there would be a summer season, that this year it could be done in a way that was safe but also beneficial for the economy. And now they say that if you come from a country outside of the European Union that has a good health situation and you can prove that you've been vaccinated with an EU-approved vaccine, although that could be expanded to the Russian and the Chinese, and you could technically come here for a holiday. It's been more than a year in which the European Union has banned non-essential travel, so that is a big reopening for Europe.
Yep, it is, although I can assure you 3 PCR tests, a lot of online filling in. It takes a lot to travel anywhere for 2 days. The question is, I know on this show, is whether people will get to Ibiza to have a little bit of a party. Will there be a summer season?
Well, look, that's what they're hoping. And then yesterday, the head of the European Commission, Ursula von der Leyen, was very clear on this. She said, now it really is a time to revive our tourism industry. We know also that European countries, in particular the southern European economies, had been pushing for this, Manus, for months. This is a big industry, it's a big money maker for the southern economies. But there's still a number of question marks that come up here. One, of course, is consumer behavior. Will people want to actually go on a holiday abroad? Will they want to travel this year? And then secondly, of course, it has to do with the politics and reciprocity. If the European Union wants to allow visitors from the UK or the US, you could argue they would expect reciprocity. If that doesn't happen, then this could become much more complicated.
Okay, Maria, thank you very much, Maria. Today, they're on the ground in Brussels with the very latest on vaccines and freedom. Yogi Dewan is Hassiam Asset Management. He's still with us. Yogi, listening into that, if you have a vaccine, you will get special privileges. Again, very much a hodgepodge of policy from different countries. It's what we've seen over the past year. Is this part of the reason why you remain underweight Europe? And if not that, why?
Directly and indirectly, yes, Manus. Now, remember, Europe's up 13% year to date in terms of equities, and the UK up just over 9%, and valuations are much more reasonable. But the issue in Europe is obviously vaccine distribution and rollout. It will have a profound impact on the unemployment rate, which is way behind the US. And obviously, it's bound to have an impact on earnings as well. And remember, it's earnings that drive share price appreciation. So you've got really negative short-term sentiment around vaccines and unemployment, and a negative medium to longer-term sentiment around earnings numbers. The only saving grace here is that valuations are more reasonable, and of course the euro is significantly undervalued versus the US dollar, which should help with an export-led recovery longer term. But these are things to look out to later in the year. They're not immediate, they're not short to medium term.
No, but look, we've had various people come on here and say we will have herd immunity by June. And so perhaps this is the two sides colliding in terms of our interpretation if there's more to go in the equity story. Yogi, you say the euro is undervalued. Yesterday, I had big pieces from Citi and from Deutsche Bank talking about 127, 127.5 on the euro. Where will the ECB tolerate a spike in the euro? Where is the discomfort level in euro, let's say, for the ECB?
I think the ECB is quite happy with where the euro is at the moment. It's some 15 to 16% undervalued on a PPP basis. You can tolerate a little bit of euro strength, but I think they're more focused on the impact a stronger euro will have on unemployment and also the potential for inflation longer term. In terms of a specific level, I don't think they're looking at one. I think they're more concerned about the asset purchasing program. They're more concerned about tapering. Obviously, inflation targets and overshoot is now permitted, and the question mark is where will rates be, and they're not really sure about that, which is why they're not really sure about where the euro should be. They know it's undervalued. They're happy with it being undervalued. They've got other things to focus on that are far more important in terms of their recovery.
I see that you're neutral. I want to pivot to the commodity in the UK market in tandem, because the miners have such a heavy weighting. Oil and miners have such a tremendous weighting in the UK. You are neutral on UK equities. Is that the broader market or the global index, i.e. the FTSE? Because I look at the Bloomberg Commodity Index at a 12-year high, pumping on gas, and a reopening that everybody's telling me has further to run in these commodity and oil trades. What is it that could make you shift from neutral on UK equities?
Now, it's important to remember that our exposure to the UK historically over the last year has been zero. And then we went to an underweight position, and now we are at a neutral position. And the reason we've moved towards neutral is obviously the whole story around vaccine distribution and lockdown coming to an end. This again will impact on unemployment. This again will impact on earnings, and that's been the narrative. In terms of commodities, yes, a big beneficiary of the reflation trade, but of course the UK has significant exposure to cyclicals, significant exposure to financials, significant exposure to technology, and those sectors are also very significant in terms of the FTSE 100 and the FTSE 250 or the larger FTSE indices that you touched upon. We have fiscal stimulus plans in place, but of course everything has to be paid for. We're expecting additional QE on the positive, but of course increased sovereign bond supply will lead to higher yields, and then you might see that balance of rotation from equities back to bonds if yields creep higher. It's a real balancing act in the UK, but we are a lot more positive than we have been. And remember, the market is up 9% year to date, and forward PEs are around 14%. So a lot more attractive on the valuation side than the rest of Europe and also the US.
Yogi, return and give me your assessment on risk in a month's time. Yogi Dewan, Hassam Asset Management CEO and founding partner. We thank you for joining us. Coming up, Bill and Melinda Gates are going their separate ways. The couple announced their divorce on Twitter, but made no hint of what happens to the joint fortune, $146 billion. We discuss. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's Daybreak Europe with me, Manus Cranny, in Dubai. 27 years of marriage, and Bill and Melinda Gates are going their separate ways, according to an announcement made on Twitter by Bill Gates. The couple jointly control a fortune of $146 billion, but there was no hint of their financial plans. Joining us now is Danny Berger. Danny, they are resident in Washington State. That has various implications in terms of when people divorce. But they have the most influential foundations in the world. I've met Bill Gates. He's an incredible individual with a power to unite the world. What do we know about the fate of the marriage?
Well, the way that they described it in the divorce filing, and this was obtained by TMZ, they called their marriage irretrievably broken. But besides that, there wasn't a lot of details, and certainly not a lot of details about their finances. But they were very clear both in the tweet that Bill Gates sent out and a statement by a spokesperson that they plan on working together in the foundation. So the statement saying that no changes to their role or the organization are planned. They're going to continue to work together to shape and approve strategies and set the overall direction. And you'd have to imagine both of them are certainly known as pragmatists. And if they were to split the foundation, that would dilute its overall impact. So that would be a surprising outcome and an unlikely one at that. And the foundation, the way it's split, it already has focuses of things that Bill Gates is interested in and things that Melinda Gates are interested in too. So, you know, Melinda having to go off, set up her own foundation, that wouldn't necessarily be necessary because she already does focus so much through the Bill and Melinda Gates Foundation on causes that are interesting to her.
But, of course, we've seen one other major divorce go through. The Bezos family splitting that fortune, and that foundation did ultimately split because some people would say, well, you identify yourself in your own right if you have the power over your portion of the foundation. So what about the Microsoft stock, which is, I suppose, the driver for both philanthropy?
Well, so it is going to be much more messy than Jeff Bezos and Mackenzie Scott because most of their fortune was in Amazon stock. So there's this big question, what happens to the company? However, Bill Gates only owns about 1.3% of Microsoft. You'll recall he stepped off the board. So the fate there is not as in question. Instead, it's more about Cascade Investments, where most of his money is in, and most of the Microsoft stake has been shifted into the Bill and Gates Foundation, Manus.
Okay, Danny, thank you very much. 27 years together and coming apart at the moment. Danny, thank you so much for being with us. We'll track that story. It is one of the most read stories on the Bloomberg terminal. Now, commodities, they're kicking new highs, the highest since almost 2012. The demand, the cycle, the boom we discuss right here.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Friday is Jobs Day on Bloomberg Television. Will the unemployment rate continue to fall, and how will markets react? The surveillance team breaks down the numbers. The April Jobs Report, Friday morning at 8:30 on Bloomberg Television and Radio.
From our Middle East headquarters in Dubai, I'm Manis Krani. It is Daybreak Europe. These are the headlines setting your agenda. Jay Powell paints a picture of a patchy economic recovery, while the Fed's John Williams says don't expect a policy shift. Well, not just yet. US futures trade lower. Germany pushes ahead with plans to exempt the fully vaccinated from restrictions. Meanwhile, the FDA is reportedly set to authorize Pfizer-BioNTech to vaccine children 12 to 15 years of age. And the couple behind the world's greatest fortunes and philanthropic operations are set to divorce. Bill and Melinda Gates separate. We have the details this hour. A warm welcome to Daybreak Europe. Good morning to you. Mr. Powell at the Federal Reserve has given us his guidance on the economy. There is real progress. That is what he is saying, but there will be many left behind. There are 8.4 million less people employed than we were at the start of the pandemic. You're going to need to see a string of 1 million new jobs created every month before the taper discussion takes place. There are long-standing disparities. I bring you the split in races. It's a Bloomberg scoop on the data. We have broken down the differential in the communities. This is Mr. Williams' view. It's different this time. We have data and conditions that we're seeing that are not nearly enough for the FOMC to shift its view. He's saying it's not like the year 2000 in terms of credit, lending and borrowing. The cycle is not what it was in 2015. Honestly, if I hear another person tell me it's not the same inflation, I really will have a different opinion of what I will say to them. The growing divide, Bloomberg has run the numbers. The gap between black and white employment, the gap is widening. The gap between other ethnic minorities, Hispanic to white, is widening. This is the truth. This is groups of people who are being left behind in this recovery as house prices rally, equity markets rally, and money is cheap. So that is the risk that you look at in this recovery. To the markets, I show you Tesla and Amazon took a little bit of a tech swipe. That took some juice out of the market yesterday. It will be an uneven recovery in the market, according to Jay Powell. Bank of America say investors are becoming more defensive. SPOs are down by 0.25%. Tens are sub 160. The market leans into Powell's I would say probably more to Williams' guidance that it's different this time for a liftoff as it was in 2015. And the Bloomberg Commodity Index is at a 12-year high. Aussie dollar, the RBA jawbones the currency. Nothing new there. That's what central bankers are learning to do with aplomb. Now, Bitcoin, shall we have a flash of Bitcoin? How's your Bitcoin exposure? It's down. Ethereum is up. Bitcoin down by 1.4%. But another leg to go to get back to the $64,000, which is the record. I mentioned commodities in the sweep. Let's talk about the prices. We've jumped to new highs amid rising hopes of renewed energy demand. The Bloomberg Commodity Spot Index, as I just showed you, a level we haven't seen since 2012. Oil is climbing after the European Union proposed easing travel restrictions. Copper is on a tear. Bloomberg Intelligence sees the metal top of the commodity pile and the top candidate for a sustained price appreciation. The US joins other nations focusing on a greener future. Let's get to Syed Rahim, Trafigura's chief economist. Syed, great to have you with me. We have many debates. Goldman say commodities could rise by another 13.5%. How would you describe where we are in the commodity and the recovery cycle? Good morning, sir.
Good morning. I think we are seeing an economy globally that is still operating somewhat below its full capacity. So call it something like 90-95%, but getting much higher up there. But yet you look at the prices, and when we talk about the start of a new cycle, et cetera, if you look at it, and if I'd said to you in January of last year, before the pandemic hit, that we are going to be down something like 4 million barrels a day of oil demand, and yet the price is going to be exactly where it is today, you would have said, look, we're at the start of a really strong cycle. And I think that's exactly where we are. You know, we've seen copper prices more than double off of the lows. We're seeing strong backwardation in many markets, meaning people really want the physical material today rather than waiting for it for a couple months, because just demand is extraordinarily strong across the globe. And it's not limited to one sector. And it's all the way from the macro to the micro. All these things are telling us the same thing.
So that's a very bullish jumping off point. Let's digest and segregate. Let's get to China. In terms of the demand outlook, let's say, for copper and iron ore. Where are we in that? Because they're trying to lean into slightly less emissions. So that is a risk in that scenario. So talk me through the demand outlook in China on the two bases.
So I think two slightly different stories. I think on iron ore, they're trying to cut emissions. They're trying to be more environmentally friendly. So they're saying we want to reduce capacity. Counterintuitively, somewhat, what that has meant is that then the price for the high-grade iron ore has actually increased substantially. As you close capacity, then some of these units, they want to run them, higher-grade material to still get you that same kind of quantity. So that's pulling up the premium price contract really there. A lot. But you are seeing strong demand for construction. That continues. They still have plans to redevelop a lot of areas. Still a lot of housing that needs to be built, especially in the interior in the West. So that still is very much there. On copper, again, as they're becoming more environmentally conscious, this move towards cleaner energy, electric vehicles, electric vehicle charging points, grid rollout, all of these things require more and more copper. So the outlook there is absolutely, not just China, but elsewhere as well, remains very, very strong in our opinion. And you can see that with the way the flows are going, with even some of it saying, some of these, the premiums would suggest you shouldn't be seeing material come into China, and yet you are. And that's telling you, again, that demand is very strong on the ground as far as we can tell. But I do think that this is a story that goes well beyond China.
Okay, so take me beyond China, and I am going to push you for Trafigura's estimate on prices. Mike McGlone at Bloomberg Intelligence says we're going to need to make it above $10,000 to perpetuate this super cycle. So how far can copper run on the upside without being a threat to demand? In other words, that demand destruction, is that anywhere in your psyche?
We're not seeing that yet at all. And in fact, for copper, it is very hard to substitute away. You can do a little bit of it in some of the high voltage lines. You can bring in some aluminium, but copper's unique properties in terms of conductivity, ductility, all of that really makes it very, very unique and very hard to replace. And generally, what you're doing is you're substituting away from other things into more electricity and into things that require more copper. So as you transition away from oil, for example, you're going to move more towards electric vehicles. That requires 4 to 5 times more copper. You move away from coal, you're going to move into solar and wind. That, again, requires about 4 to 5 times as much copper. So it's all going that way. And then to my point, outside of China, I think this is the point, is that it doesn't just have to be China that is supporting this rally. We are looking at a global, multi-regional, multi-sectoral rally here, where for the first time in a very, very long time, you really have strong demand coming out of the U.S., Europe, Japan, Korea. If you look at all these manufacturing numbers, already we're at very, very strong levels. You look at the new orders, those are very strong. And beyond that, we still have 1 to 2 more stimulus plans yet to come out of the U.S. And if any portion of those come through, then we really are looking at a supercharged cycle here.
And the infrastructure plan by Biden is one of those big green infrastructure plans. We've got the EU initiatives on green. Is that in this price cycle so far, or will that add to a multi-year dimension to what you've just said to me?
I think this is multi-year, because for commodities, you're not pricing future growth. What you're saying is, this is the price I'm willing to pay for the material today. Really the shape of the curve does the rest of it. And I think that's not being reflected yet. We haven't seen the stimulus plan go through. So therefore, we haven't seen, companies or producers really placing the new orders for that material, because it's not real yet. It's not tangible. Once the legislation gets passed, in the form that it gets passed, then people start to adjust their buying. And then that's when we'll really start to see, I think, this price action come through. So in our mind, we think that there's quite a bit of more upside still yet to come here.
Saad, thank you very much. My guest this morning on the Commodity Supercycle. And miles to go before we sleep. Trafigura's chief economist, Saad Rahim. Some breaking news coming across the Bloomberg terminal now. Let me bring this to you. It is in Mexico. You are looking at live pictures here. It's a race subway track, and it has collapsed. This is Mexico City. Plunging train cars. Passengers are on board now. So far, we understand that at least 13 people have lost their lives. That's according to officials in the nation's capital. So this is the recovery operation underway. About 70 people have been injured in the accident. And Miriam, Urzua, the city's civil protection secretary. She gave us these details in an interview. Just looking at these pictures, the rescue efforts are underway. So it was 7 carriages, as I say, off a line of 12 subway trains plunging into this. We'll keep it across that story, and as we get more data and information on the situation on the ground, we will bring that to you. Let's get to Annabelle Droulish. She has your first word news. Annabelle.
Thanks, Manus. Well, the White House is backing Pfizer's move to begin exporting US-made doses of its coronavirus vaccine. The governments of Mexico and Canada said last week they're expecting to begin receiving the vaccines from the US. The New York Times is reporting US regulators could authorize the Pfizer-BioNTech shot for 12 to 15-year-olds as soon as this week. There are signs that Europe's biggest players are moving closer to the US when it comes to a standoff with China. Secretary of State Antony Blinken used talks in London this week to push back against Beijing. Speaking with UK Foreign Secretary Dominic Raab, he said the West is trying to uphold the international rules-based order that countries like China and Russia are challenging. Germany plans to spend an additional €5 billion to slash emissions from the steel industry. The country is stepping up efforts to hit increasingly stringent climate goals. The money will go towards supporting hydrogen projects by steelmakers. It will also be used to smooth the transition to low-emission metal production. Global News, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Manus?
Annabelle, thank you very much for the update. Annabelle Droulish there in Hong Kong. Now, Saudi Aramco, we're waiting for the numbers to drop across the Bloomberg terminal, and Bloomberg Intelligence expects the recovery in the oil demand and the rising prices to improve the oil giant's cash generation in 2021. That should help the company increase the spending and reduce its debt. Let's get to our Middle East equities reporter, Felipe Pacheco. He's sitting patiently waiting for the numbers to drop across the terminal. So just remind our viewers what we're looking for in terms of net income and revenue, Felipe. Good morning.
Good morning, Manus. Yes, it's a big day for Saudi Aramco and for the Saudi market in general. Of course, looking at the numbers, we have a compilation of 15 analysts by the company, and they expect net income for the first quarter to be at $19.4 billion US Manus. This would represent a 12% increase from what we had as an adjusted net income in 2020 for the same period. If we look at total revenue, we are expecting around 271 billion reals, and that's a compilation by Bloomberg with 3 estimates. Of course, there's a lot of expectation when it comes of any kind of indication by the company when regarding capital spending. Higher oil prices could lead to an increase in that line for the year of 2021. Now, last year, we had Saudi Aramco joining a list of major integrated oil companies, Manus, that were actually cutting capex by about 20%. And within that group, we had BP, Shell, Exxon, Chevron, Total, Eni, and also Equinor. So it would be interesting to see if the company is going to change its projections and its plans when it comes to capex.
Now, we've had quite a cracking recovery in the oil price, haven't we, over this first quarter? I suppose the risk there is that OPEC Plus might put more barrels back on the market. But how would that rally in oil translate to Aramco?
That's right, Manus. We've seen a quite strong recovery for oil throughout the first 3 months of the year. And, well, we had an interesting estimate by Bloomberg Intelligence by our colleague Saleh Ilmaz. And he put in a note last month that a 39% sequential increase in the benchmark oil pricing could result in an increase of 30% for the first quarter net income for Aramco. And this is despite the OPEC Plus accord that limits oil production at around 8.1 million barrels a day, both in February and in March. He also highlights a very important point for the company that was announced in the first quarter, which was the $12.4 billion sale of a stake in its pipeline rights. And that could also, of course, boost the company's financial framework for the whole year and could generate an excess free cash. Another very important point that was part of the announcements by the Saudi government earlier this year is that they announced this major plan for local companies to just redirect dividends to major projects within the kingdom. It wasn't very clear how this would happen, but Aramco would somehow take part in this initiative. Still, the shareholders, the
Felipe, we're going to have to leave it there. We're waiting for the numbers to drop across the Bloomberg terminal. We'll return to that story as soon as we get the information. Felipe Pacheco, our resident equities reporter here in Dubai. Coming up on the show, the G7 foreign and development ministers, they meet in person in London this week. The world is reopening to politics and business. The international agenda is set. It's a beautiful day in London, the Dome of St. Paul's. The City of London is coming back to life. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
It's Daybreak Europe with me, Menace Cranny, in Dubai. My co-host, Anne-Marie Horton, has taken holiday. Disgraceful. Now, the G7, the development ministers, they're going to gather in person for the first time in 2 years. How to read a room. The meeting is set to be held this week in London amid strict COVID-secure measures. Let's get to our executive editor for international government, Rosalind Matheson. Rosalind, it sounds like multilateralism is being rebirthed by Blinken and Dominic Raab. Good morning. What's prompted the shift by Europe?
Good morning. Well, what we're seeing is quite a turnaround from Europe, although, of course, Europe as a collective remains wary of being pulled into a very overt anti-China policy by the US. So it's still a bit more calibrated on that, especially from Germany. That said, this big investment deal that they finally agreed on in December has not been ratified and is going to have a very tricky time getting done. That's because of rising concern over China's actions in its own neighbourhood, primarily against the Uyghur Islamic population in Xinjiang, over Hong Kong, tensions with China, and a general sense of upset that China hasn't really been a good actor during the pandemic in terms of sharing information. So even as it's negotiated this investment deal, it's still not showing genuine progress in opening up its own economy to the world and to companies from Europe in key sectors that it protects its state-owned enterprises. So all of those things seem to have come together to have led to a bit of a hardening on the European side, which will be interesting to track in terms of how much it draws closer to the approach of the Biden administration.
Rosalind, thank you very much. We'll leave you with pictures there of Mr. Blinken talking about upholding a rules-based order, and Dominic Raab talking about agile clusters of like-minded countries sharing the same values. More on the political front throughout the morning programming. Rosalind Matheson, our executive editor for International Government. Coming up, Bill and Melinda Gates are going their separate ways. But what happens to the fortune, $146 billion? We'll have the details. This is Bloomberg.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
How do you start your morning?
Guess who won the fight in a commercial break? This black eye you've got right now looks so authentic.
You let him get in a good punch.
Wake up with Bloomberg Surveillance, weekdays on Bloomberg Television.
It's Daybreak Europe with me, Manus Cranny, in Dubai. Now, the pair at the helm of one of the world's biggest fortunes are set to split. It was a tweet that arrived yesterday, Bill and Melinda Gates announcing their plan to file for divorce after 27 years of marriage. But what happens to their wealth? Let's get the details. Simone Foxman joins me now. So, Simone, the number that will reverberate across the Bloomberg terminal is $146 billion. What do we know about the fate of one of the most influential foundations in the world?
Well, certainly on the foundation side, Manus, we understand that Bill and Melinda are going to continue in their roles at the Bill and Melinda Gates Foundation. At least that's the message that we're getting at the moment. But when we look at that $146 billion, that big pot of wealth, a lot of that is in their family office called Cascade Investments. It's managed by Michael Larson, and this is really known as one of the most institutional, the best run family offices in the world, very much held up as a model of what to do as a family office. In fact, part of that's because Bill and Melinda, while they have general investment ideas, they're not super involved in picking the specific investments themselves. And we understand that that investment vehicle, some $58 billion, this also has a lot of investments in the likes of land ownership, energy, real estate, hospitality. Those things would be difficult to split up if the two were to decide to do that. As of this moment, though, we have no indication that that's actually the direction that they're going.
And in terms of the question marks that are going to be asked, it is whether that foundation might be split in two. That's what happened with the Bezos' fortune. So what is the biggest question?
Yeah, and the Bezos fortune was heavily into Amazon stock, so that's not a concern that we have as much here with Microsoft stock. These folks account for just 1.3% of the ownership there. The big question is what happens in the court system. Washington is a community property state, and most of the wealth that the Gates have has been acquired since they married in 1994. That's also the same time the current CIO of Cascade Investments came in, started managing both the family office as well as the endowment for the foundation. We don't know if they have a prenup, and we may never know how a judge kind of splits up this wealth because a lot of these questions are handled behind closed doors. Certainly if the two agree to kind of keep everything together, keep that pot together, both the foundation and the family office could continue to be enormous players in the world of philanthropy and the world of investments. That's something that both seem to want to do despite the divorce.
Absolutely. Well, they probably want to deliver a message of continuity really to the foundation, those charities that they look after on many occasions. A truly amazing individual, having met him a couple of years ago, and the work that they do. Simone Foxman there joining us from Doha. We are waiting for Saudi Aramco. How much will they spend on CapEx? What will be their leverage number? And will the net income be $19 billion for the first quarter? This is a company which has reverberations around the world in terms of investment, FDI into the kingdom, selling assets and generating fiscal latitude for the Kingdom of Saudi Arabia. I leave you with a splendid view of St. Paul's.
One of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, you know, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Good morning. Welcome to Bloomberg Markets, the European Open. I'm Anna Edwards, live in London. The cash trade is just less than an hour away. Here are your top headlines. Jay Powell paints a picture of a patchy economic recovery, while the Fed's John Williams says don't expect any policy shift just yet. U.S. futures trade lower. Germany pushes ahead with plans to exempt fully vaccinated people from restrictions. Meanwhile, the FDA is reportedly set to authorize the Pfizer-BioNTech vaccine for children aged 12 to 15. And the couple behind one of the world's great fortunes and philanthropic operations are to divorce. We'll discuss Bill and Melinda Gates this hour. Welcome to the program, everybody. It is Tuesday morning, just under an hour away from the start of cash equities trading here in Europe. Let's have a look at the futures and what they tell us. European equity market futures then looking a little bit as if we need some catch-up perhaps for the London market. So DAX futures flat to negative. FTSE futures looking more positive. Maybe the FTSE is yesterday's story, because if you look at US futures, you'll see that US futures also moving to the downside. We had these comments from Jay Powell about patchy economic recovery. Also, if we have a look at where we were yesterday in US trading, it was quite mixed in the US, but the Nasdaq in particular under pressure. So we'll look for any read across into tech stocks. That's been part of the conversation through Asia. Tesla, Amazon, they weighed on the Nasdaq yesterday. Looking at the GMM, you can see we have some positivity coming through from some Asian markets, but a number of them are of course closed. So Japan closed, China closed. So we are seeing a more mixed picture perhaps globally than the GMM might suggest. The GMM showing us some of the moves to the upside that we are seeing coming through in certain Asian markets. Away from the Asian equity story, which does look fairly positive in isolation, you see some other reasons for caution. For example, the dollar moving to the upside, up around 0.2%. The yield on the US 10-year around the 1.59 mark, so having ticked back down, those yields having ticked back down just a little bit. We continue to keep across, of course, the recovery story in the United States, the commodities story, the inflation story. We'll get to a lot of that. Commodities, a gauge of commodities at their highest since 2012. So we'll get to all of that narrative and, of course, continue to cover the latest on the virus. It's not just India we're talking about when it comes to emerging markets affected in particular by that fight against the virus. That continues to be a narrative we need to tell. Let's get back to the market story then, or focus in on that market story a little bit more. Danny Berger has a rundown of what's caught her eye this morning. Danny.
And I really do think if already the inflation genie wasn't out of the bottle, it certainly is now, and it's not going to be able to go back in. And I really think that ISM manufacturing report in the U.S. yesterday really added to the story of companies that we've heard during earnings really grappling with the supply chain. So manufacturing missed. And I just want to go over some of the comments that these companies talked about because they're revealing. So someone said there appears to be general inflation of prices across most, if not all, supply lines. Lots of work on the floor, but I'm worried about getting the materials to support. Steel prices are at crazy highs, and demand continues to be strong, but supply chains hamper our availability and ability to sell more. So that mixed with the ISM prices of commodities going to its highest since 2008 really shows you just what an issue this is. And the reaction in the markets was swift. You had stronger oil, weaker dollar, but that's reversing today. So it really is the dollar dominating the direction of where some of these risk assets go. And perhaps this has more to do with Powell talking about the patchy economic recovery. So dollar stronger, oil a little bit weaker. But look, that weak equity story continuing to shine through with those inflationary pressures, and especially big tech being the more weak out of the future indexes. But Anna, you point out the one thing that is continuing to hold onto this narrative of manufacturing bottlenecks is commodities. So the Bloomberg Commodity Price Index trading at its highest since 2012. It continues to move higher today. I mean, it has really taken off. So this increasingly is becoming the story, not just for the commodity markets, but the equity markets and other risk assets as well, Anna.
Yeah, commodities and inflation certainly very much part of the conversation we'll be having today, Danny. And I see that Trafigura, of course, they know a thing or two about trading in some of these metals. And Trafigura saying that the strong demand for copper that we've seen, or more more upside rather to come for copper prices as a result of that strong demand from Europe, US and China. So we'll keep across that story. Danny, thanks very much. Danny Berger with the latest on these markets. Coming up here on the European Market Open, grab your sunscreen and your passports. We will talk about the chances of international travel this summer with the CEO of the booking platform Trivago. Coming up also on this programme, we speak to the UK International Trade Minister Ranil Jayawardena, as the UK and India announced new trade deals. That discussion after 8 a.m. London time. If you have any questions of your own to put to our guests, if you have access to a Bloomberg terminal, IB Plus TV Go is the function to use, and we will endeavour to get those to our guests for you. This is Bloomberg.
Early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the European Market Open. 50 or so minutes to go until the start of cash equities trading. Futures are fairly mixed this morning. You might expect to see a little bit more upside in London. London was closed, of course, yesterday. So FTSE futures up by 0.4%. Elsewhere, a little more muted, and US futures flat to negative. Let's get a Bloomberg First Word News update. Here with some of the top stories we're covering this morning here at Bloomberg. Here's Laura Wright.
Thanks, Anna. In India, Prime Minister Narendra Modi is resisting pressure to lock down the country despite the surge in virus cases and deaths. 2 weeks ago, he said states should only consider lockdowns as a last option. But now everyone from political allies to business leaders see it as the only way to stem the world's worst coronavirus outbreak. Bill and Melinda Gates are getting divorced after 27 years of marriage. The two say they'll continue to work together on the Gates Foundation they created, which has so far given away more than $50 billion. According to Bloomberg's Billionaires Index, the pair are worth an estimated $146 billion. Germany plans to spend an additional €5 billion to slash emissions from the steel industry. The country is stepping up efforts to hit increasingly stringent climate goals. The money will go towards supporting hydrogen projects by steel makers. It will also be used to smooth the transition to low-emission metal production. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna,
Laura, thanks very much. Laura Wright here in London. Now, confirmed coronavirus cases in the United States rose at the slowest pace since the start of the pandemic. Meanwhile, most capacity restrictions will be lifted across the New York area, while all-day subway service will resume. The city that never sleeps will be a 24-hour city again, starting in mid-May. That is according to the governor, Andrew Cuomo. Fed Chair Jay Powell says the economy is making real progress, but it has been slower for those in lower-paid jobs. We're joined now with a global perspective by David Lambert, Senior Portfolio Manager for European Equities at RBC Global Asset Management. David, good morning to you. Your focus on European equities, but the US recovery story, I'm sure, crucial to that. How are you looking at the pace of the US recovery and adjusting your portfolio here in Europe with that in mind?
Well, I mean, the US always leads Europe, so we always have to keep an eye on what the US is doing. But in terms of the recovery, I suspect we've got to be looking at Europe now in terms of the vaccination program improving on continental Europe. So we can see more of a catch-up in the recovery from European names and European companies. So in essence, it's given us a window into what we might expect within Europe and the UK over the coming 6 months. But it's positive. It looks good.
How concerned are you about inflation? If this is going to be something, David, that maybe stalls things in their tracks or at least takes the edge off what could otherwise have been possible? I'm thinking about the US factory growth numbers that cooled and supply chain issues. They're cooling from a very high level, of course, but supply chain issues, material shortages, the high prices of some of those commodities, very much part of the conversation. Is that something that companies that you're speaking to are discussing as well?
Absolutely. I think from the most recent earnings season, the one thing that's come out, apart from good earnings beats and improving outlook, has been the input price pressure that companies are seeing. Now, this obviously leads to a drag on margins over 1 or 2 quarters as the pass-through isn't immediately possible. But actually, from a longer-term perspective, you know, this plays catch up. So we've seen quite a big move in commodity prices in the last month, and that's very hard to deal with. But actually, if I look 2, 3, 4 quarters down the line, then actually one would expect the margin structure to catch back up with the cost pricing pressure. So actually, it's not as concerning if as long as the commodity price inflation isn't as strong as it's been in the last month. In terms of inflation in general, you know, in terms of what we're seeing, we've got to ask our question, is it something more transient or more sustained? I suspect at the moment it's more transient. We're coming off a very low base from this time last year. But I guess at the moment we've got policy and stimulus demand supportive of inflationary pressures, and it's how long these are sustained for as to how long we see this continuing into the medium and long term.
Yes, and I suppose it's how supportive that backdrop remains. David, you say that these are transient, and I wonder what's the pivot? What defines transient for you? Because the Fed says it's transient too, and lots of people wonder what exactly that means. How long is a transient pickup in inflation?
Well, I guess how long's a piece of string? But transient, I would say, would be around 12 months, and medium term, I would sort of 3 to 5 years in the future. So again, if we think about the sort of rolling effect of lapping last year's numbers, then once we get to the end of 2021, then I would expect that these numbers would come down, you know, sustainably and significantly. So there's no real answer to what transient is, but I would say 12 months.
Okay, good to, yeah, I put you on the spot there, didn't I, David? But what about the chip story? Because, of course, the negatives of all this higher commodity prices and supply chain disruption, that's clear to see in many of the conversations that we have with businesses. But there's one sector that's really been doing very well out of the back of a supply shortage around chips, and that is the chip makers. This is something that Europe does do, even though it is a global industry. Where in the tech space are you looking at for high returns then, David, as we come out of this, as we recover across Europe? Is it those chip names?
Yeah, I mean, I think there's a couple of places in tech. I mean, chip names and anyone supplying into the manufacturing of the chip process, because we know that the demand profile there is sustained, has got a good trajectory into the medium and long term. So I think that's a good place to be, and particularly where we've got European companies that are global leaders, and we have a few of those particularly. But then on top of that, I think when we look at the tech sector, you know, it's naturally a capital light area of the market. so software and services. If you can find global leaders with higher barriers to entry there, then these the capital-light nature of these businesses turn them into cash machines effectively. So there are plenty of opportunities in Europe. The problem one has is the valuations ascribed to some of these names. So the market is pretty alive to the prospects for some of these businesses. So it's about paying the right price for great companies. And that's our job, I suppose, at the end of the day.
Yeah, David, thanks very much. Stay with us. David Lambert from RBC Global Asset Management. He stays with us. Just as David was talking to us there about the chip sector, we're having numbers crossing from the oil sector. So let me get to that right now. We have Saudi Aramco producing numbers this morning. First quarter operating profit, 151.89 billion rials. That is an increase of 17% year on year when you take that first quarter and compare it back to the first quarter of the previous year. A Q1 profit of 78.59 billion rials. That is up 24% year on year. So those numbers just crossing the Bloomberg terminal now. Coming up on the programme, we discussed the bumper earnings bonanza that we are seeing. We talked a little bit about some of the themes coming through in earnings season. We'll get back to that conversation and talk about relationships with China as well. That conversation next. This is Bloomberg.
Why did you decide to become Secretary of Commerce? Because in Rhode Island, you're the 800-pound gorilla because you're the governor.
Because I wanted to be on the team that helps America build back.
Welcome back to the European Market Open. 42 minutes to go until the start of cash equities trading this Tuesday morning. It is Tuesday. The London market was closed yesterday, so FTSE futures looking a little out of kilter with the rest of Europe perhaps, but up by 0.4% right now. So we might see a little bit of standout performance there. Elsewhere, things more muted, including on the US futures front. Now, Estée Lauder reported a strong gain in sales in the third quarter, but its results fell short of Wall Street expectations. Estée Lauder Executive Vice President and CFO Tracy Travis spoke with Bloomberg Television on Monday in an exclusive interview.
Our expectations are we'll see gradual improvement as it relates to the recovery. And again, we're seeing, some setbacks in a couple of markets, but in other markets are quite strong. When we look at China, when we look at Israel, when we look at Australia, which, are ahead of other markets in terms of their return to pre-pandemic levels, we see strong growth across all categories, inclusive of makeup. And we're seeing the face category come back. We're seeing lips come back. We're seeing mascara and eyes, which had been the stronger categories during the pandemic anyway. But we're seeing that, recovery in makeup, while skincare and fragrance, which have been strong performers during the pandemic, continue to be strong. So, but I do think when there is a resumption of social occasions, when there is a resumption of more professional occasions, when you think again about the U.S., there is the expectation that people will be going back to school, back to work over the next few months. Those are all opportunities for a makeup recovery.
Tracy, do you think you've got an opportunity to raise prices here?
Certainly as we look at inflationary pressures, we are a prestige company, so we do have pricing power. And as we, look at some commodity prices that are going up, transportation costs are going up, it would be our expectation, as we do every year, to raise prices, yes.
But staying on that for just a second, we talk a lot about the shortage of supply across the board in so many different industries. Can you give us some insight as to where you might be seeing that right now?
In terms of our supply?
Yeah, like your supply chain, et cetera, or even labor. Like, where are you seeing rising costs or shortages?
Yeah, we're seeing shortages or rising costs and some pressure in just transportation. In terms of our own supply, we actually have not seen any pressure on our supply chain related to components or any of the inputs into our manufacturing processes, other than obviously upward pricing pressure, which we have a number of strategies to try to mitigate, inclusive of pricing for some of that pressure.
What does China look like?
We have been in the U.S. as well as in overseas markets expanding capacity. So when you think about double-digit growth, certainly we've been investing in expanding capacity for skincare and had already done so for makeup.
Well, where are you doing that? China's one of the markets that has opened up the most quickly. Can you just kind of walk me through where you are seeing the biggest opportunity right now, where you think you're going to expand?
Yeah, we announced a few months ago that we are opening a new plant in Japan in the next 12 to 24 months. It will ramp up to scale. In addition to that, we've been investing in our manufacturing capabilities here in Long Island in New York, as well as in Canada, which is where we do a lot of our makeup production. So really in all of our plants, given the double-digit growth that we've seen over the last couple of years, outside of obviously last year when the pandemic hit us quite suddenly.
That was the Estée Lauder Executive Vice President and CFO, Tracy Travis. Now, earnings are in full swing and European companies are delivering one of the best seasons on record. It's driven a rally in the Stock 600, which has climbed more than 10% this year. That's as expectations of a rapid economic recovery thanks to vaccinations and continued loose fiscal and monetary policy. David Lambert from RBC Global Asset Management is still with us. David, let's think about the earnings story and the reaction we've seen in stocks, because I've had a couple of conversations over recent weeks where people have said, yes, earnings have been kind of impressive, but there hasn't been necessarily at the individual stock level the reward for strong performance that you might have expected to see. And yet we're talking here about a recovery in the Stock 600. So where are we seeing the reward for strong earnings coming through, do you think?
Well, I think you're exactly spot on, and that's something that always puzzles. Well, it doesn't puzzle us, but I think it gives us clues to what's going to happen going forward. So, yeah, as you say, it's been a terrific earnings season. I mean, historically in post-recovery years, earnings tend to come through at analyst expectations or exceed them, whereas normally you see downgrades coming through as the year progresses. This year it's been upgrades, and upgrades are generally good for markets. But actually, you're right. What we've been seeing is a kind of a divergence in some areas of the market between the earnings upgrades and the share price reaction. And that kind of normally gives us a sign of fatigue, of potentially more rotation in the market. So that's something we're looking out for. And let's not forget, we've just come off April's always normally a seasonally good month. Now we're coming into a seasonally dull period for the market. So maybe what's happening to these reactions are just giving us a sign that the market's a little bit tired. But notwithstanding that, operationally, what we're seeing from companies, we're lapping over 12 months some sort of low marks, but we're still seeing progress quarter over quarter. So it's good for operational perspective.
Yeah, tell me a bit about where you might see that fatigue as we go into May, then, David, and that cliche hangs over us of sell in May. Where do you see that fatigue coming through? Is it fatigue in the original tech trades, or is it fatigue in the rotation away from tech into value stocks that has been much discussed over recent months?
Yeah, I suspect it's more in the cyclical areas of the market. So, some of the cap goods, some of the chemicals, some of the autos names, things that have had a remarkably good run over the last 9 to 12 months. I'm not necessarily thinking we move back into tech necessarily. What I would say, what I have noticed is that an area of the market that is performing a lot better is things like consumer staples. So actually more defensive areas of the markets under the radar are starting to improve. So again, we've had good numbers, but the share price reactions have also reacted well in those areas of the market. So it feels as though that monster move we've seen in some of the cyclicals, needs to take a breath. I'm not saying they correct, but I think that's probably where we would see these divergences occur, even in the earnings reporting coming in the next couple of weeks as well.
This week, David, we see the US administration here in Europe trying to drum up support for their stance towards China, and arguably that's having some effect on European politicians, a little less positive in their view on China than they were just months ago now. Is that something, briefly, David, that's going to take the edge off recovery for some European companies, that geopolitics, or is it still on the sidelines?
Potentially, yeah. I mean, I think when you look at it every quarter, when we sort of highlight all our sort of macro risks, Chinese tensions is always on that list. And, an escalation of any tensions with China and the EU wouldn't be good for, we've got many companies within Europe that have large Chinese and emerging market exposure. So, yes, that's something we're conscious of and we are keeping a very close eye on.
OK, David, thanks very much. Thanks for your time. David Lambert, Senior Portfolio Manager for European Equities at RBC Global Asset Management. Thank you very much for joining us. Coming up here on the programme, to book or not to book, that is now the question for many planning their summer holidays. We will talk about the outlook for the vacation season with the CEO of the global accommodation search platform, Trivago. That conversation coming up next. Axel Hafer will be joining us. The Trivago CEO comes to speak to us here at Bloomberg in just a few minutes' time. This is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. Half an hour to go until the start of Tuesday's cash equity session. You can see some divergence across Europe. The FTSE was closed yesterday, so looks to catch up today. Expected to be higher at the start of trade. Elsewhere, a little bit more muted to the start of Tuesday's trading session across Europe. And US futures still point flat to negative. Now, the European Union is aiming to reopen its borders after months of pandemic restrictions, with plans for quarantine-free travel for vaccinated visitors. The new system could be in place by June, just in time for the summer season. The EU is also working on ramping up its own vaccination programme, which could help drive demand. That's a trend global accommodation search platform Trivago is already seeing in countries with higher vaccination rates like Israel and the United States. I'm pleased to say we're joined now by the CEO of Trivago, Axel Heffer. Very good to speak to you, Axel. And let's start with the reopening story around Europe and the plans to allow freer travel without quarantine for those who are fully vaccinated or from low-risk countries. How exciting are these developments for a business like Trivago?
I mean, overall, we are very excited to see a gradual return of the travel market overall, of course. As you rightly said, Israel and the US are leading the way there, and Europe is on a good track. And the one thing that has held back travel in the last 12 months is the uncertainty about transportation. Can you actually get to your destination, and can you get back without any quarantine restrictions that are imposed on a short notice? So a clear structure in place will be very, very positive for the summer season.
So that could be positive for the summer here in Europe, Axel. And in terms of the European story, are you seeing any early bookings that can tell you anything about where customers are coming from, where they're going to, anything that looks worth mentioning?
Yeah, I mean, generally speaking, you see a high correlation of the progress on the vaccination rollout and local travel activity. So there was an improvement in the UK. For international travel, you obviously need some certainty about the quarantine restrictions in your destination country. So that is still holding back. But also in some of the southern European markets in the last couple of weeks, we've seen some pickup in demand, given that there is a more positive outlook on local travel.
I see that for your business, though, so this is the sort of the picture across the markets and looking ahead with a bit more optimism, Axel. When we look at the first quarter numbers that you just reported, adjusted EBITDA loss, the loss of 4.8 million euros, you've said things are going to improve, I think, from that perspective. A positive adjusted EBITDA in the second half of 2021 is your expectation. When is the pivot going to be? When is the pivot point where things start to get much better for a business like Trivago as you look ahead into the summer?
I mean, to be honest, this year is not so much about generating a lot of profit, because we are coming out of one of the worst pandemics that we've seen, at least in our lifetime. So in the beginning, it is about getting the traveler comfortable to travel again and to communicate that traveling is safe again. And that comes at a cost. So there will be some inefficiency in that communication and marketing, because certain segments of the population will not feel safe to travel this year. And only over the next 2 to 3 years, everybody will return to the market. So for us, success this year is really a steady improvement in overall volume and success in communicating that travel is safe again in the summer. And that's what we are looking forward to. EBITDA will then follow with more and more people traveling. It obviously will become more of a focus in the future.
You've expanded, Axel, your offering of alternative accommodation. So rather than hotels, independent travel accommodation, I suppose, or self-catering, we've certainly seen rivals in that sector have a relatively good pandemic. Is that something that's going to be with us for a time, that pivot towards the self-catering end of the market?
Yeah, we don't think so, to be honest. I mean, our approach has always been that you need to offer everything because travelers are increasingly not looking for a specific kind of accommodation, but more a kind of stay and a kind of experience, and that you can have by various different types of accommodation. What you've seen clearly in the pandemic, also fueled by the staycation trend, is a boom in alternative accommodation, but with the overall market coming back, there is a lot of supply in traditional hotels, and that supply scales much more quickly than an increase in supply of individual apartments. So we do expect the overall market to rebalance and be much closer to where it was before the pandemic in the months to come.
That's interesting. We've seen strong competition in traditional meta search, which has led many many investments outside traditional accommodation. We've talked about self-catering, but tours and activities, flights, package trips, subscription services. What's your expectation for how that comes back? I hear what you're saying about hotels being easier to scale.
Yeah. So overall, I mean, we have launched 2 new products very recently. I mean, one is our local travel product, but which we do think is a very good solution for particularly the next couple of years, where international travel will still have some friction through new variants that are spreading across the globe. So there will be a focus on local travel, which we are addressing with a new offering in the UK and the US for now. The other thing that we have recently launched is in partnership with TUI Amusement, is an offering of activities, which is for us strategically very interesting because it gives us the opportunity to also offer services to our travelers in destination, whereas with our traditional products, we focus more on the time of booking. And that is now a much more complete offering. And yeah, you're right. I mean, there is a shift in our overall direction to have multiple offerings and complement the core meta search offering, where it's all about getting the best deal for your accommodation at the booking stage, and try to be with our user a much longer period of time.
How are you thinking about advertising at this point, Axel? It was interesting to see some of the numbers coming through from Alphabet, which showed in the US a pickup in travel and leisure advertising. I spoke to WPP's CEO not long ago, and he was talking about how we're a little behind that trend in Europe. How are you thinking about the ramp up in advertising?
It's a very good question. It's not that straightforward, to be honest. It used to be much easier, where you had your typical seasonality. Right now, we have to be prepared to advertise pretty much everywhere at any point in time and really take decisions week by week, because you don't want to be very aggressive and promote travel at a point in time where incidents are actually increasing and additional lockdown restrictions are reimposed. But generally speaking, we are planning to advertise when we see that travel is safe, and we want to promote travel when it is safe and basically support the restart of the market. So it's all about timing, having the right message at the right point in time. And that's much more challenging than it used to be, but that's a challenge for everybody in the travel industry.
Yeah, really interesting perspective. Axel, thank you very much for joining us. Axel Heffer, the CEO of Trivago. Thanks for speaking to us here on Bloomberg TV. Let's get a Bloomberg Business Flash. Some of the top corporate stories we're covering this morning. Here's Laura.
Thanks, Anna. Profits at oil giant Saudi Aramco soared in the first quarter. The recovery in global oil and gas markets helped the state-owned firm maintain its dividend. It kept the quarterly payouts at nearly $19 billion. Almost all of it goes to the Saudi Arabian government. The bumper results follow strong earnings from other big oil names like Shell and BP. Apple's battle with the maker of Fortnite has begun in federal court. Epic Games is alleging that Apple's App Store leaves users and developers trapped in an anti-competitive marketplace. But the iPhone maker is hitting back, accusing Epic of a fundamental assault on a business model that has helped millions of developers. Robinhood is hitting back at Warren Buffett after he said the online brokerage played a part in the casino aspect of the market. In a tweet, the retail trader favorite said the old guard preferred it when investing wasn't so easy, adding that Robinhood isn't going to sit back while its users are disparaged for taking control of their financial lives. That's the Bloomberg Business Flash. Anna.
Laura, thanks very much. Laura Wright here in London. Coming up on the programme, Bill and Melinda Gates are going their separate ways. The couple announced their divorce on Twitter, but made no hint of what happens to their joint fortune of $146 billion. We get the details next. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. 40 past 7 here in London, 42 minutes past 7, which means 20 minutes until the start of the European equity trading session. You can see some sluggishness expected in the up-to-date markets, if you like. The FTSE 100 playing catch-up after being closed yesterday. Now, the pair at the helm of one of the world's greatest fortunes are splitting up. In a tweet yesterday, Bill and Melinda Gates announced they plan to file for divorce after 27 years. But what happens to their enormous wealth? Joining us now to break down the details is Bloomberg's Simone Foxman. So Bill and Melinda Gates have one of the most influential foundations in the world. Simone, what do we know about its fate?
Yeah, and the big question here is whether or not they ultimately decide to split their wealth in pieces. At least right now, the message from the foundation is no, both can plan to continue to stay on in their roles at the organization and work together to set the foundations and the overall direction of the Bill and Melinda Gates Foundation. Notably, if we're talking just about the foundation side, Bill and Melinda kind of have a little bit of a different focus. Bill really big speaker and notable voice on climate change, whereas Melinda Gates tends to focus on advocacy for women and for families and society. So there is the potential that those two don't cross over quite so well. But obviously the foundation spending about $5 billion a year to fund these causes, it's a question mark whether or not it can continue to do that if they were to decide to divide their responsibilities.
Yeah, Simone, tell us a bit about how their money is invested at this point.
Yeah, and so we talk about the foundation being so powerful, but also that $146 billion pool of wealth, mostly managed by a man named Michael Larson. He controls the family office called Cascade Investments. He also manages money for the foundation, and he has been doing that since 1994. That's actually the same year the couple were married. Now, important to that is that he grew this pot of wealth from about $5 billion, that's an estimate from the Wall Street Journal, to the $146 billion that it runs today. Notably, they're invested in things like real estate, hospitality, energy, in addition to sort of the investments the foundation makes. Those things, you know, a lot of these are direct deals. Those things would be difficult to split up if they were to do so. Cascade, really known as a model of the institutional family office, but that also may make it easier to just kind of keep everything together. This one guy is running things and doing it quite well and has made you a lot of money through the years.
What are the other questions that are going to be asked as we go through the divorce, as it winds its way through the court system? If it gets to that point, Simone, then what are the question marks that are going to be arising?
Yeah, and certainly there's a 90-day kind of cooling off period where we're not going to see any moves, and then ultimately we may not know exactly what happens. But what we do know is that Washington is a community property state. That is where the couple resides, and that means that both individuals will have a claim, equal claim to the assets that were acquired during the marriage. Now, I mentioned that $5 billion to $146 billion figure. That's the community property element is going to inform exactly where those assets go. But as I said, a lot of this could happen behind closed doors, particularly if the relationship is amicable and the two do continue to work together. We may not know exactly how those assets break down.
Simone, thanks very much. Bloomberg Simone Foxman joining us with the latest on Bill and Melinda Gates. Now let's get back to our markets conversation. Commodities very much part of the narrative in recent weeks, and iron ore futures in Singapore are pulling back modestly after hitting around $190 a tonne as demand optimism builds. Juliet Starley joins us now from Singapore. And Jules, Citi is calling for further upside for iron ore. What's the latest thinking then around this particular metal?
That's exactly right, Anna. In fact, they're saying that you could see the metal hit $200 within weeks. We know that China curbs on emissions, also demand optimism over the global economic recovery, pushing iron ore faster and higher. And we also had some pretty solid data in terms of Australian exports for iron ore hitting a record in March, up 21.2%. Citi analysts also saying that you've got this multi-year iron ore deficit in the seaborne market, and that will prevent prices from falling immediately back to the producing cost levels of below $100. So as you mentioned, we did see futures jump to more than 190 here in Singapore, up 3.5% in the morning session after 5 weeks of advances, and that's flowing through into the momentum you've been seeing in a lot of these iron ore producers as well. BHP, a very solid one when you look at analyst recommendations on the Bloomberg, and Bloomberg Intelligence saying that these higher iron ore prices will offset any bump in prices at Rio Tinto. They're forecasting a marked improvement in Rio's operating performance over 2021 due to this jump you're seeing in iron ore, Anna.
And the commodities rally is impacting on other assets as well then, Jules. It's also sparking a jump in some EM currencies, for example, and parts of the credit market. What are the forecasts there?
Yeah, we've heard from Mark Reed over at Mizuho, and he does say that there could be a little bit of an impact to the credit market, saying it could be a bit of a double-edged sword here because you've also got this impact of higher inflation too. But as we know, April was an incredibly strong month for commodities, the best in 5 years following 9 months of gains in the past 11. And many investors here actually expecting more gains as the world pulls out of the pandemic. So we've seen the Bloomberg Commodity Spot Index jump to its highest level since 2012. That has helped also lift
with the MSCI Emerging Markets Currency Index near a record. And you've also seen some movement in broader Asian emerging market dollar bonds. But over at Societe Generale, Frank Benzuma saying that this climb that you are seeing in commodities doesn't necessarily mean that you wouldn't see it flow through into stocks as well. He's seeing some additional overall support for equities as we continue to see this very strong rally coming through across the commodity market. Anna.
Yeah, support for some, headwinds for others. Juliet, thank you very much. Juliet Sali joining us there from Singapore with the latest on the commodities story. Let's get a Bloomberg First Word News update. For that, here's Laura.
Thanks, Anna. There's more easing of pandemic restrictions across New York, New Jersey and Connecticut. All-day subway services will resume on May 17th with capacity restrictions on restaurants, theatres and stores ending on May 19th. New York Governor Andrew Cuomo described it as a major reopening of economic and social activity. The White House is backing Pfizer's move to begin exporting US-made doses of its coronavirus vaccine. The governments of Mexico and Canada said last week they expected to begin receiving the vaccine from the US. The New York Times is reporting US regulators could authorize the Pfizer-BioNTech shot for 12 to 15-year-olds as soon as this week. There are signs that Europe's biggest players are moving closer to the US when it comes to a standoff with China. Secretary of State Antony Blinken used talks in London this week to push back against Beijing. Speaking with UK Foreign Secretary Dominic Raab, he said the West is trying to uphold the international rules-based order that countries like China and Russia are challenging. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Well, thank you very much. Laura Wright here in London. Coming up on the programme, we will look at your stocks to watch. Just 10 minutes to go until the start of Tuesday's trading session. And we've talked about chips and the shortage of chips. Infineon, as the German semiconductor manufacturer, gets a boost from strong chip demand. That's not very much in focus. We'll talk about the stocks we're watching. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome back to the European market open. 8 minutes to go until that market open. For cash equities, at least, the futures looking mixed. As you can see, London was closed yesterday, of course. Let's get the stocks we're watching. Danny Burgett joins us with a breakdown. Danny.
Infineon, Anna, one of the ones to watch today, reporting earnings, and they beat expectations. They're higher in pre-market trading on TradeGate, but the question around Infineon is one that's going to plague anyone that touches the chip industry, and that's these supply bottlenecks. They talked about it. They said it still remains an issue despite the booming market and manufacturing running at full speed. So the question will soon become, do you start to price that into the stocks themselves, perhaps in terms of a worsening margin, or do you just assume that this bleeds into the inflation picture, Anna?
Yeah, lots of interesting stuff to watch then when it comes to the way that chip stocks in Europe perform through this. Let's get to the Italian media space, where I know we've seen some news flow as well, Danny.
Yeah, this is a Bloomberg scoop, Anna. Vivendi and Mediaset have been engaged in a years-long battle, more or less, and lawsuit over a failed takeover attempt from Vivendi trying to buy the pay TV section of Mediaset. Now, that fell through. Mediaset sued Vivendi in billions of damages for abandoning the deal. Well, finally, they've agreed to drop all legal disputes. As part of the deal, Vivendi will sell most of its stake that it built up around 2016. So at the moment, it's about 19% of Mediaset. And Mediaset, at the same time, their shareholders will vote on an extraordinary dividend.
Interesting. I've just been drawn to some comments coming through from the Paris Airport's CEO talking about when we're going to see recovery in that particular part of the aviation space. I know that you've been looking at IAG, Danny. What's the focus there?
Well, Paris Airports was actually one of the highest traded stocks yesterday. Lufthansa also did really well, and of course that's sort of trading on the back of this idea that probably mostly American tourists, but any fully vaccinated tourist is going to be able to go into the EU. So a lot of the long-haul carriers did well off the back of that. And because London was closed yesterday, we could see IAG play a little bit of catch-up rally off the back of that. It's unlikely that maybe some of the discount airlines will rally because, again, this is mostly about long-haul, or at least it seems so at the moment, Anna.
Right. Well, I'm sure that many policymakers in Europe have the UK market in mind when they're thinking about these policies. We'll see how that develops. Danny, thanks very much. Our markets reporter, Danny Berger, with the latest on the stocks that she's watching at the start of the European trading day. Just 4.5 minutes to go until the start of European equity trading. Then we'll be back with the European Open shortly. Futures looking divided, as Danny was reminding us there. Of course, the UK was closed yesterday, so perhaps a little bit of catch up to the upside for UK stocks. Elsewhere, things looking a little flat. US futures point slightly to the downside. The Open is next. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Welcome back to the European Market Open. A minute to go until the start of cash equities trading for this Tuesday morning. Here are your headlines. Jay Powell paints a picture of a patchy economic recovery, while the Fed's John Williams says don't expect any policy shift just yet. US futures trade lower. Germany pushes ahead with plans to exempt fully vaccinated people from restrictions. Meanwhile, the FDA is reportedly set to authorize the Pfizer-BioNTech vaccine for children aged 12 to 15. And the couple behind one of the world's great fortunes and philanthropic operations are to divorce. We'll discuss Bill and Melinda Gates. Good morning, everybody. Just 10 seconds then to go until the start of the European equity trading session. Let's take a look at these futures, a little bit skewed by the fact that London was closed yesterday, so FTSE futures to the upside, up by about 0.5%. Elsewhere, things looking a little bit more muted, as you can see there on DAX and CAC futures. And as we get to the start of the European equity trading session, then European equity markets just waiting to get the full picture, but the FTSE 100 is open, up by around 0.4%, so playing a little bit of catch-up from yesterday. The IBEX opens an 0.8% to the upside, and so a lot of focus on the London market and the catch-up story there, or a lot of sway being given to that perhaps by the Stoxx 600 this morning. But elsewhere, things looking a little bit more muted. So we've got the CAC 40 in Paris up by 0.2% and the DAX up by 0.1%. So European equity markets opening broadly to the upside, of course, skewed by that reopening of the London market. Market seems to be looking through the persistent threat of the pandemic of the vaccine rollouts. Joining us now is Mike Bell, JP Morgan Asset Management Global Market Strategist. And Mike, very good morning to you. I wanted to start with the really big picture, the picture for stocks, the arguments for owning stocks at this point. A lot of people concerned around valuations, of course, as we are not far from all-time highs. But you've been asking whether we're anywhere near the end of this journey to higher stocks, and you don't think so because we don't see a recession looming on the horizon. Talk us through the logic, Mike.
Yes, and it's very simplest. If you look historically, you want to be invested in equities unless you think there's going to be a recession in the next 12 months. Now, the probability of there being a recession in the next 12 months seems extremely low to me, given that we've got huge amounts of pent-up savings in most parts of the world, that they're going to get deployed and lead to really quite a spectacular growth outlook, actually, over the next 12 to 18 months. Now, the other sort of concern that we see at the moment is around inflation and the kind of risks that that could pose. But I think, again, historically, if you look at it, what tends to happen is that investors need to worry about inflation only when it causes central banks to put interest rates up to the extent that it causes a recession. Now, the Fed are probably going to be putting rates up maybe sometime in 2023, but I wouldn't be worried about what that does to the economy and hence for equity markets until they've probably got base rates up to somewhere near 2%, which I think is several years away. So I just think it's premature to be worrying about the next recession and therefore what's going to happen to equities. Now, you mentioned valuations. I think on the valuation point, in the US, it's true that particularly some of those growth stocks look a bit expensive compared with history. But elsewhere in the world, in EM, valuations look pretty reasonable. In the UK, valuations are cheap relative to the rest of the world as they've been in 20 years. And even in the US, we're finding lots of stocks in the sort of cheaper parts of the market, which we think have attractive earnings outlooks over the next few years, given that lack of recession.
Okay, so even in the US, because of that lack of recession. So if you see interest rate rises coming in 2023, and you don't think we need to worry, we shouldn't worry too prematurely about the Fed's reaction function and its ability to sort of curb the enthusiasm, where do you see inflation heading then, Mike? How temporary is temporary, I suppose, I'm thinking about this morning when it comes to an inflation spike? Because many people are talking about the inflation spike, and even central banks don't deny that the inflation spike is either here or coming. What is temporary, though, when we look at inflation and that story?
I think temporary is really over the next 12 months. I think if in 12 months from now, inflation's come back down to maybe not right below target, but inflation somewhere in that sort of 2 to 2.5% range 12 months from now, then I think that we'll be looking at this as a temporary pickup, and then the Fed are not going to be having to worry about hiking rates quicker than people are currently thinking. So even if we do get above target inflation, though, and it's more persistent, right? So I think the jury's out as to exactly how temporary this pickup in inflation is going to be. Even if we end up with, say, 3% inflation for the next 3 years in a row, I still think we're in a world where it's too early to be worrying about what that means for the economy. Because, yes, it means that the Fed would put interest rates up sooner than they otherwise would. But it still means, I think, that we're several years away from the point at which interest rates get to such a level that they slow the economy and actually cause a recession.
And we also know, of course, that the Fed is not just looking at that inflation story, is it, Mike? It's looking at unemployment. It's also looking beyond aggregate numbers on the US economy. And maybe this is a big departure from the past. I know that Bloomberg, we've done a lot of analysis of the recovery being experienced by different groups, by minority communities, for example, in America. How much is this set to stay the hand of the Fed? How much is this going to be something that means that the Fed is more cautious, takes its time more in this rate hiking cycle?
Well, I guess it depends on the speed of the labour market recovery. Now, I'm actually pretty optimistic on the speed of the labour market recovery, because when you look at where the job losses have been, a lot of them are in that hospitality and leisure sector, which I think is going to be the part of the economy that absolutely booms over the coming months. Because, as I say, we've got pent-up savings. People are going to want to go out and eat and see friends that they haven't seen for the last year. And so I think a lot of that employment could come back a lot quicker than it has in previous recoveries. Now, nevertheless, though, I think even if the Fed is right that we get to 3.5% unemployment by the end of 2023, then it's just talking about a world where interest rates are not going to be getting to 2%, probably until at least 2025. And that's the kind of time where you maybe start to want to worry about what it means to the economy and for equity markets. But I think not right now.
And how much of a pivot are you doing, Mike, or is it too late to pivot into some of those travel stocks? You mentioned the pent-up savings and what people are going to want to do with those. I'm looking at the reaction we're seeing after one-day closure yesterday, of course, for London markets. There's a bit of catch-up, but also factoring in the latest news flow around Europe and the intention to open up travel. IAG up 2.6%, EasyJet up by just over 2%, TUI listed in London up by more than 5%. How much of this recovery in travel is already behind us, Mike, in anticipation of it actually happening, and how much is still to play for?
There probably is some more upside on the assumption that we get back to a world where people are traveling like they used to. But I think that, particularly some of the airlines, is even in a world where no one even has to think about COVID anymore, are people still going to do as much business class travel as they used to? Because some of the airlines, a lot of their profitability comes from selling business class flights. And in a world where corporates have learned that you can do a lot of meetings online, I think people are still going to travel, certainly for business. But is it ever going to get back to where it was pre-COVID? I think that's the big question mark still hanging over some of those airline stocks.
Yeah, interesting perspective. Thanks for flagging that point, Mike. Thank you very much. Mike Bell stays with us, JP Morgan Asset Management Global Markets Strategist. We'll hear more from Mike in a short while here on the European Market Open. Coming up shortly, though, ahead of a virtual summit between the leaders of the UK and India, we will speak to the UK International Trade Minister, that is Ranil Jayawardena. That conversation coming up next. This is Bloomberg.